Thank you for joining us at XM.com for today's daily market comment by Raf Boyajian. I'm Christina Marujos. Hopes that a slowing American economy and easing price pressures would assuage the inflation hawks at the Fed were dealt a major blow on Monday, spoiling the post-NFP risk rally. San Francisco Fed President Mary Daly was the latest FOMC member to maintain her forecast that rates would need to rise above 5%, while Atlanta Fed Chief Raphael Bostic's comments rattled the markets after he suggested he might not back a rate cut before 2025. The message from the Fed is that officials are keeping their options open for downshifting to a 25 basis points rate hike as early as the February meeting, especially if Thursday's CPI numbers are also weaker than expected. However, the door to a rate cut or even a pause appears to be tightly shut for now, and that's what's upset the markets. Sentiment could yet change, though, as Chair Powell himself will be speaking later today at 2 o'clock GMT in a panel discussion organized by Sweden's Riksbank. On Wall Street, the Fed's unwavering stance revived fears about the U.S. economy being unable to avoid a hard landing, though the real concern is how well valuations will hold up in a weaker demand environment. And the upcoming earnings season, which kicks off this Friday with the major banks, should shed more light on this. Both the Dow Jones and S&P 500 came off their highs yesterday to finish the session in the red. Tech stocks were the exception, however, as the sharp reversal on Treasury yields since the end of December, which gathered pace on Friday, has taken the pressure off the Nasdaq, with Tesla leading yesterday's rally. In the commodity sphere, oil futures were mixed on Tuesday. Copper futures edged lower, but lower bond yields and a sluggish U.S. dollar are keeping gold prices buoyed in what has been a strong start to the new year for the precious metal. The greenback was somewhat steadier on Tuesday after sliding sharply against a basket of currencies on Monday when it hit 7-month lows. In contrast, expectations that a recession in Europe might not be very steep, even as the European Central Bank sticks to its aggressive tightening path, lifted the euro above the $107 level. This was a daily market comment here at XM.com.